Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Already we have completed 29 problems on variance analysis. Now I'm going to start the 30th problem. So already I have completed the problems on material variances, labor variances, and we have started the problems on overhead variance. So in this video, two more problems on overhead variance I am going to explain. After that, I am going to start the last topic, that is sales variances. That will be the end of the topic of standard costing and variance analysis. I told you earlier in the previous videos that the problems depend on the formulae. So if you are perfect on the formula, then only you can be able to understand, you can be able to solve the problems on variance analysis. First video, introduction part, I have explained you in detail about the four variances: material variance, labor variance, overhead variance, and sales variance. I have explained all the formulas. If you have watched those, first video, then definitely you don't find any difficulty while understanding the problem. Suppose if you have not watched the first video, if you are unaware about the formulas, it will be very difficult for you to understand this video. So my suggestion, go to the playlist of my channel, select the subject Managerial Accounting, select the topic Standard Costing Variance Analysis. Watch the first video, and then starting 2-3 videos are very important basic problems on material variances. So if you get the grip on the problems of material variances, slowly we can go ahead in remembering the formulas for labor variance, overhead variance, like that. So before starting the 30th problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready before start watching the problems. Now problem number 30th I am reading out. From the following data for a factory for the month of January 1981, compute overhead variances. So it is asking you to calculate overhead variances. What is the data given? Number of units produced, standard 15,000, actual 8,000. This is the quantity, units produced. Variable overheads are 30,000 standard, actual 15,500. Fixed overhead standard 45,000 and actual 46,000. Very limited information is given. We are given only fixed overheads, variable overheads, and number of units. Still time is not given, so we cannot calculate all the ratios. From this limited information, we can calculate only one fixed overhead cost variance, FOCV, fixed overhead cost variance, and 3 variable overhead variances. So totally 4 variances we can calculate: 1 fixed overhead variance and 3 variable overhead variance. That's it. Now see, first fixed overhead cost variance, FOCV. So the formula for fixed overhead cost variance is actual output into SFOR per unit. SFOR, standard fixed overhead rate. SFOR stands for standard fixed overhead rate. Here I will write down fixed overhead, FOCV, standard fixed overhead rate. First we are calculating FOCV. Now fixed overhead afterward. First of all we will calculate variable overhead. First we calculate variable overhead, First we calculate variable overhead, then we will go to fixed overhead. So variable overhead, VOCV, variable overhead cost variance, is equal to actual output into standard variable overhead rate per unit minus actual variable overhead. So only 1 variable overhead and 3 fixed overheads. I take a pardon here. 1 variable overhead and 3 fixed overheads. The variable overhead cost variance, VOCV, is equal to actual output into SVOR, standard variable overhead rate per unit, minus actual overhead. So first we require SVOR per unit. Standard variable overhead rate per unit is equal to standard variable overheads divided by standard output. Standard variable overheads. The standard variable overheads are given 30,000 and standard number of units produced are given 15,000. So 30,000 divided by 15,000, 2 rupees. So SVOR per unit is 2 rupees. Now we substitute the value in the formula VOCV, variable overhead cost variance, actual output. In the problem, actual output is given 8,000 units. Actual output is 8,000. So 8,000 units into SVOR per unit, 2 rupees. So 8,000 into 2, 16,000. Minus actual variable overhead. In the problem, it is given actual variable overhead 15,500. 15,500 actual variable overhead. Now 8,000 into 2, 16,000. Minus 15,500, 500 rupees favorable, because positive we are getting. Positive variance is favorable, negative variance is adverse. So positive 500 favorable. One variance completed. Everything depends on the formula, so you have to remember the formula. VOCV, variable overhead cost variance, is equal to actual output into SVOR per unit minus actual variable overhead. So first we require SVOR per unit. How to find out per unit? Standard variable overheads divided by standard output, standard production. So if you 30,000 divided by 15,000, 2 rupees SVOR per unit. Substitute, will get 500 rupees VOCV. Now fixed overhead variances. 3 fixed overhead variances we are going to apply, find out. First one, FOCV, fixed overhead cost variance. The formula will be exactly same as VOCV. VOCV. So see here, VOCV and FOCV, exactly same formula. The only difference is instead of variable, now we are putting fixed. That's it. The formula FOCV, actual output into SFOR per unit. Here what you have taken, SVOR per unit. Here I am taking SFOR, standard fixed overhead rate per unit, minus actual fixed overheads. Actual fixed overheads. Here you have taken actual variable overheads because the variance was variable. So actual variable overhead. Now we are calculating fixed. So actual fixed overhead. So first of all, we calculate SFOR per unit, standard fixed overhead rate per unit, is equal to standard overhead, standard fixed overheads divided by standard output. So standard fixed overheads are 45,000. You can see the problem given. Standard fixed overheads 45,000. Standard output 15,000. So 45 by 15, 3 rupees per unit SFOR. SFOR 3 rupees. Substitute. FOCV is equal to actual output 8,000 units. SFOR per unit 3 rupees. So 8,000 into 3, 24,000. Minus actual fixed overheads 46,000. So 24 minus 46, 22,000 adverse. What we got? FOCV, fixed overhead cost variance. Now fixed overhead cost variance is bifurcated into fixed overhead volume variance and fixed overhead efficiency variance. Now fixed overhead volume variance, FOVV. VV stands for volume variance. The fixed overhead volume variance is equal to actual output into standard fixed overhead rate per unit minus budgeted overheads. Budgeted overheads means standard overheads. Remember, when it is given budgeted overheads, it means standard overheads. Both mean same. So here, actual output 8,000 units given in the problem, and SFOR per unit, just now you have calculated 3 rupees. SFOR per unit 3 rupees minus budgeted overheads. Standard fixed overheads are given 45,000. 8 3s are 24,000 minus 45,000, 21,000 adverse. What is this 21,000 adverse? FOVV, fixed overhead volume variance. Lastly, fixed overhead expenditure variance. Fixed overhead expenditure, EXP stands for expenditure. So fixed overhead expenditure variance is equal to budgeted fixed overheads minus actual fixed overheads. Very easy formula. Budgeted fixed overheads minus actual fixed overheads. So 45,000 budgeted fixed overheads, actual fixed overheads are 46,000. So 1,000 rupees adverse. One variable overhead variance we have calculated and 3 fixed overhead variance we have calculated. Now you can confirm, verify whether our calculations are correct or not. Fixed overhead cost variance. is equal to fixed overhead volume variance plus fixed overhead expenditure variance. In other words, volume variance plus expenditure variance is equal to cost variance. Now we'll verify. What is the volume variance here? 21,000 adverse. 21,000 adverse is the FOVV, or FO expenditure variance 1,000 adverse. So here 21,000 adverse, here 1,000 adverse. Add this to 21,000 plus 1,000, 22,000 adverse. This is the FOCV. That means our calculations are correct. FOCV is equal to FO volume and FO expenditure. That's it. So in this problem, we have calculated one variable overhead cost variance and three fixed overhead cost variance, fixed overhead variances. So fixed overhead cost variance, fixed overhead volume variance and fixed overhead expenditure variance. Now next, 31st problem. This problem number 31 is the last and final problem on overhead analysis. Next, see the 31st problem. Calculate overhead variances, standard actual. Number of units standard are 4,000, actual 3,800. Working days, standard 20 days, actual 21 days. And fixed overheads standard 40,000, actual 39,000. In this problem, we are not given variable overheads. So we have to calculate only fixed overhead variances. And the new point given in the problem is working days are given. The previous problem, working days was not given. So here one more formula, calendar variance also we have to calculate. Fixed overhead calendar variance because number of working days are given. Now see carefully. FOCV, fixed overhead cost variance is equal to actual output into standard fixed overhead rate per unit minus actual fixed overheads, just like the previous problem. What we have applied in the previous problem, exactly same we have to apply in the current problem. The fixed overhead cost variance, actual output into SFOR per unit minus actual fixed overhead. SFOR per unit, standard fixed overhead rate per unit is equal to standard overheads divided by standard output production. The standard overheads are 40,000 and standard production is 4,000 units. So 40,000 by 4,000, 10 rupees per unit is the SFOR, standard fixed overhead rate per unit. Now you substitute FOCV is equal to actual output 3,800 given in the problem. Actual output into SFOR per unit 10 rupees. So 3,800 into 10, 38,000 minus actual fixed overhead incurred given in the problem 39,000. 38 minus 39,000, 1,000 rupees adverse. What is this 1,000 adverse? FOCV. Negative variance is adverse. Here we are getting negative. That's all. One variance we have completed, FOCV. Now FO expenditure variance. Very easy formula. FO expenditure variance is equal to budgeted overheads minus actual overheads. Budgeted means standard. So here budgeted overhead minus standard minus actual overhead. Budgeted overheads are 40,000, actual overheads are 39,000. So 1,000 favorable. This is fixed overhead expenditure variance. Two variances completed. Now fixed overhead volume variance. So actual output into SFOR per unit minus budgeted overheads. Same formula what we have applied in the previous problem. So actual output 3,800 units. SFOR per unit just now we have calculated 10 rupees. 38,000. Minus budgeted overheads. Budgeted overheads are given in the problem 40,000. So 38 minus 40, 2,000 adverse. What is this 2,000 adverse? FO volume variance. Fixed overhead volume variance. Now fixed overhead efficiency variance. Here you need some concentration. Fixed overhead efficiency variance is equal to SFOR per day. SFOR. Previous problem we have not applied efficiency because the number of days are not given. Here number of days are given, that's why we have to calculate efficiency. Fixed overhead efficiency variance is equal to SFOR per day, standard fixed overhead rate per day into standard time for actual output minus actual time taken. So what is the formula for fixed overhead efficiency variance? SFOR per day into standard time for actual output minus actual time taken. So first of all, SFOR per day, standard fixed overhead rate per day, is equal to standard overheads divided by standard number of days. Standard overhead divided by standard number of days. The standard fixed overheads are 40,000 and standard number of days are 20 days given in the problem. So 40,000 divided by 20, 2,000 rupees. The standard fixed overhead per day is 2,000. Now standard time for actual output. It is given in the problem for an output of 4,000 units. For a standard output of 4,000 units, standard time is given as 20 days. For making 4,000 units, 20 days are required. But the actual output is not 4,000. The actual output is 3,800. So for making 3,800 actual output, how much would be the standard time? So 3,800 by 4,000 into 20, you get 19 days. So this 19 days is the standard time for making actual output. For making actual output. Now efficiency variance. Standard fixed overhead rate per day. How much is the standard fixed overhead rate per day? 2,000. So 2,000 into standard time for actual output. Standard time for actual output 19 days. And actual time taken is given in the problem 21 days. Actual time taken 21 days. So 19 minus 21 into 2000, you will get negative figure, adverse, 4000 adverse. What is this? Fixed overhead efficiency variance. Now next one, fixed overhead calendar variance. CAL stands for calendar because number of days are given. Fixed overhead calendar variance is equal to standard rate per day, standard fixed overhead rate per day, SFOR per day, into actual days minus standard days. So here standard rate per day is 2000, already we have calculated, into actual number of days 21, standard number of days 20. So 2000 favorable is the calendar variance. That's all. Now you can verify whether our calculations are correct or not. So how to make the verification? Fixed overhead cost variance is equal to fixed overhead volume variance and fixed overhead expenditure variance. Fixed overhead volume plus fixed overhead expenditure variance. If you add up these two, you should get fixed overhead cost variance. Now we'll check. Fixed overhead expenditure variance is 1000 favorable and fixed overhead volume variance is 2000 adverse. So volume variance is 2000 adverse and expenditure variance is 1000 favorable. So subtract 2000 minus 1000 is 1000. 1000 adverse. Because here sign is more adverse is more than favorable. Adverse is 2000. Favorable is only 1000. So from 2000 deduct 1000. 1000 adverse will remain. Check whether 1000 is there or not. Yes. FOCV 1000. That means our calculations are correct. Our formulas are correct. Secondly, one more verification. FO efficiency variance. Now FO volume variance. FO volume variance is equal to FO efficiency variance plus FO expenditure calendar variance. Efficiency plus calendar. If you add up these two, efficiency and calendar, you should get volume variance. Fixed overhead volume variance is equal to fixed overhead efficiency variance plus fixed overhead calendar variance. Now we'll check. How much is fixed overhead efficiency variance? Here we got 4000 adverse. 4000 adverse is efficiency variance. How much is calendar variance? 2000 favorable. So from 4000 deduct 2000. So 2000 adverse will remain. 2000 adverse. Check volume variance. Is it 2000 adverse or not? Fixed overhead volume variance 2000 adverse. Fixed overhead volume variance 2000 adverse. How we got it? 4000 adverse minus 2000 favorable. You will get 2000 adverse. That means our calculations are 100% correct. That's it. So this is the problem number 31. So this is the end of problems on overhead variances. Now the last and final topic, that is sales variance. Sales variance. Now see the problem number 32. 32nd problem. From the data given below, calculate sales variance and analyze it. So we have to calculate the total sales variance and we have to analyze it. Why this sales variance is occurring? Budgeted units sold 2000, actual units sold 1600. So actually expected sales are 2000 units, but actual sales are only 1600 units. Budgeted selling price 15 rupees per unit, but actual selling price 20 rupees per unit. So quantity is different. Quantity, actually we expect that 2000 units can be sold, but in reality actual sales are 1600 only. Quantity is different. Selling price, actual selling price is 20 rupees, whereas our budgeted selling price was only 15. That means total sales variance is arising on account of volume and on account of price. Now see here, total actual sales. Actual sales are actual quantity into actual price. Actual quantity is 1600 units, actual price 20. 32,000 rupees are the actual sales. Budgeted sales are budgeted quantity into budgeted price. So 2000 into 15, 30,000. So the actual sales are actual quantity into actual selling price. AQ, actual quantity, AP, actual selling price. So 1600 number of units, actual number of units sold, and actual selling price 20 rupees. So 32,000 is the total actual sales. Budgeted sales, budgeted quantity into budgeted selling price. So budgeted quantity 2000 units and budgeted selling price 15. So 30,000 rupees are the budgeted sales. So we have expected the total sales to be 30,000, but actual sales comes to 32,000. So sales variance, total sales variance. So total sales variance, the formula is actual sales minus budgeted sales. Actual sales 32,000, budgeted sales 30,000. So 2,000 rupees favorable. 2,000 rupees favorable. This is the total sales variance. Now total sales variance can be bifurcated, divided into two. That is sales quantity variance and sales price variance. So first of all, sales price variance, SPV, sales price variance. The formula for sales price variance, actual quantity into actual price minus budgeted price. Actual price minus budgeted price. So actual quantity is 1600 units given in the problem. Then actual price 20 rupees and budgeted price 15 rupees. So 20 minus 15 into 1600, 8,000 rupees favorable. So price variance is 8,000 rupees favorable. Now quantity variance or volume variance. Sales volume variance, SVV, is equal to budgeted price, selling price. Budgeted selling price into actual quantity minus budgeted quantity. The formula is budgeted selling price into actual quantity minus budgeted quantity. The budgeted selling price is 15 rupees. Budgeted selling price 15 rupees. Actual quantity is 1600. Budgeted quantity 2000. So 1600 minus 2000 into 15, 6000 adverse. 6000 adverse. So we have calculated sales value variance, sales price variance, sales volume variance. Now we can do verification whether we have done correctly or not. This is optional. For our satisfaction, we are verifying. The verification, total sales value variance is equal to sales price variance plus sales volume variance. So if you add up sales price variance and sales volume variance, you should get sales value variance. So sales value variance is equal to sales price variance plus sales volume. Sales price variance 8,000 favorable and sales volume variance 6,000 adverse. So which is more here? Favorable is more. Favorable is 8,000, adverse is 6,000. So 8,000 minus 6,000, 2,000 favorable. This is the verification. We got 2,000 favorable, you can see here. Total sales variance 2,000 favorable. That's it. So this is the end of 32. Now see the 33rd problem. Problem number 33. From the following data, calculate sales variance. Just like the previous problem. But previous problem only one product was there. Here we have two different products, A and B. So products A, product B. Standard units are 1500 A, 1000 B. Total number of units are 2500. Standard unit price, selling price. Standard selling price is 30 rupees for A, 50 rupees for B. Actual number of units of A, 2000. Actual number of units of B, 700. And actual selling price are 29 for A and 50 for B. That's it. This is the complete information given for two products A and B. The budgeted selling price, budgeted quantity is given, actual selling price, actual quantity is given. Exactly same formula what we have applied in the previous problem. Now here, calculation of sales variance, product A, B, standard quantity 1500, 1000, total 2500. Standard price 30 rupees, 50 rupees given in the problem. Now we have opened the column standard sales. SS stands for standard sales. So multiply 1500 into 30, 45,000, and 1000 into 50, 50,000. Total standard sales are 95,000. The budgeted sales or standard sales of both the product combined together for 95,000. Now actual number of units, actual quantity 2000 for A, 700 for B given in the problem, 2700. Actual selling price 2950 given in the problem. Now we multiply quantity with selling price to get total sales, actual sales. AS, actual sales, 2000 into 29, 58,000, 700 into 50, 35,000. Take the total 93,000. So 93,000 is the actual sales and 95,000 is the budgeted sales, expected sales. Now we can calculate all the formula variances. First, total sales value variance. Total sales value variance is equal to actual sales minus budgeted sales. Actual sales are 93,000, budgeted sales are 95,000. So 93,000 minus 95,000. Actual sales are 93,000 and the budgeted sales are 95,000. So 93 minus 95. Actual sales are 93,000 and budgeted sales are 95,000. So 2,000 rupees adverse. We got 2,000 rupees adverse. Now sales price variance. Sales price variance you can see here. Sales price variance SPV is equal to actual quantity into actual price minus standard price. Actual quantity into actual price minus standard price. So actual quantity of A 2000 and B 700. 2000 and 700. Actual selling price is 29 and 50. 29.50. Standard selling price 30 and 50. 30 and 50. So 29 minus 30 into 2000. 2000 adverse because negative we are getting. Then 50 minus 50 is 0. When 0 is multiplied with any figure, it will be 0. So 0 here. So total 2000 adverse. So 2000 adverse is the sales price variance. Now sales volume variance, SVV, sales volume variance, is equal to standard price into actual quantity minus standard quantity. So standard price is given 30 and 50. Standard price 30 and 50. Whereas actual quantity 2700, here it is given 2700 minus standard quantity 1500 and 1000, 1500, 1000. Now 2000 minus 1500 into 30, 15,000 favorable, and 700 minus 1000 into 50, 15,000 adverse. So 15,000 favorable, 15,000 adverse, cancelled to 0. So volume variance is 0. Now you can verify yourself. The volume variance, price variance plus volume variance is equal to total sales variance. If you add up the sales price variance and sales volume variance, you should get sales value variance. So here 2000 adverse plus 0 is 2000 adverse. Verified. Now we can also calculate sales mix variance because we have two types of material, two types of products are there. So sales mix variance is equal to standard price, standard selling price into actual quantity minus revised standard quantity. Actual quantity minus revised standard quantity. So first we calculate revised SQ. Total of actual mix divided by total of standard mix into standard quantity. Exactly same method what we have applied in material variances and labor variances. So total of actual mix 2700, total of standard mix 2500. So 2700 divided by 2500 into standard quantity. Standard quantity is 1500. So 1650 is the revised SQ of A. Similarly, revised SQ of B. 2700 divided by 2500 into 1000. You will get 1080. Revised SQ. Now substitute in the formula. Sales mix variance is equal to A. 30 into 2000. 30 and 50. These are the standard selling price. Standard selling price 3050. Actual quantity 2700. And revised SQ 1650 and 1080. So you will get 2000 minus 1650 into 30. 10,500 favorable. And 700 minus 1080 into 50. 19,000 adverse. So which is more here? Adverse is more. So 19,000 minus 10,500, 8,500 adverse. This is the sales mix variance. So in this video, two problems I have explained on overhead variances and two problems on sales variance. Overhead variances, I have shown you, I have explained you about the variable overhead variance and fixed overhead variance. And sales variance, sales value variance, sales price variance, sales volume variance. All these things I have explained. The only thing you have to remember the formula. After watching the video, make some practice. You'll get a good command. With confidence, you can face the examination. That's it. So if you are satisfied with my lecture, give a like to the video. Share my channel in your group, in your friend circle, so that more students can watch the video and get the confidence, command on the subject. Give the comments on these lectures. And lastly, don't forget to subscribe my channel if you have not yet subscribed. We'll continue the next problem in the next video.